Okay guys, welcome back to the channel. So this video is going to be dedicated to Divo, one of my favorite income-oriented ETFs on the entire market. And the reason why I want to revisit this ETF in today's video is because the assets under management just passed $1 billion. And if we take a look at the fund flows of Divo over time, we can see this super fast and consistent growth rate of this ETF, indicating that people are flocking to it. And that massive achievement of over $1 billion in assets under management actually now put it above names like RYLD in terms of its popularity. Now, of course, I do currently have a position in this ETF because I'm a big fan of it, and it's one of the few ETFs in my portfolio right now that I'm still in the green with. I've been investing in them since July of 2021, and they've paid me over $100 in dividend payments so far. And at a glance, here are a few things that I love about Divo. So the first being that it's a clear, transparent ETF structure with relatively low fees for what it is. The fund puts a huge emphasis on value and holding profitable companies. The dividend yield is massive for an ETF and way above the average, and the income is from two different sources: a tactical covered call writing process, which is opportunistic in nature, plus real actual dividends, and I love that combination. And finally, as I alluded to, the ETF in its current downturn is holding up extremely well, and they're paying their dividends right on time. Okay, so now let's do some comparisons, look at the data, and take a general deeper dive into this ETF. So I currently have it stacked up against the S&P 500 and the QQQ, two very popular benchmarks. We are currently looking at the 1-year view, and there's a few things we can learn from this right off the bat. So during good times when the market is going up, Divo does indeed fall behind in terms of its price action. But when things began to change in December, Divo did a great job holding on to its value in comparison to the more major indexes. To better see this, if we zoom into the past 6 months, Divo is only down 1.88%, the S&P almost 5%, and the QQQ almost 10%. And even in the past 1 month, with all the concern around Russia, Ukraine, inflation, interest rates, Divo is doing a great job holding on to its value. Now, the core reason behind this very robust price action during a falling market is because of the strong fundamentals of this ETF, focusing on dividend growth companies. We know from history that dividend growth companies in particular are some of the strongest and most resilient companies long term. Now, if we take a look at the holdings in this ETF, we see all the traditional, recognizable, blue chip dividend growth names: United Health Group, Chevron, Procter & Gamble, Apple, Visa, Microsoft, Home Depot, even very boring companies like Aflac. But the thing they all have in common is that fundamentally and financially, they're all very strong companies. In fact, if we come back to this comparison, it's very similar to another very high quality ETF, SCHD. And that's why, looking at the 6-month view, SCHD and Divo perform very similar to one another, and to me that's a great sign. Alright, now let's shift over to this tool. This is Portfolio Visualizer, and this is going to give us a lot more data on the total return of these assets. So first up we have Divo, then I have some of its peers: VTV, which is a Vanguard Value ETF, and VYM, which is a Dividend ETF. Looking at the 5-year CAGR, Divo, even with its covered calls which do limit upside potential, has still outperformed value and dividends. And it's just slightly behind the S&P 500, but if you take a look at the worst year on record, and here Divo takes a clear lead, having a lot less volatility. And if we take a look at the annual returns, it's hard to tell that Divo even has covered calls, which technically limit returns, because some years it performs better than pure equity ETFs. And finally, if we take a look at the yearly income, this is where we can see the effect of both the dividends and the covered calls that Divo implements. In comparison to a value and a dividend ETF, Divo is far superior in terms of the level of income it can generate. So I gotta say, usually I'm very skeptical of active management in ETFs, but here with the covered calls, management is clearly doing something right. They've both been able to successfully meet the goal of generating high levels of income and providing a more than competitive yearly rate of return and minimizing the downturns in the bad years. Okay, now I want to do a more realistic view on how Divo can impact your portfolio, because most likely you're not just investing in one ETF or another. So here I made 2 similar sample portfolios. In the first one, half of it is the S&P 500, 25% is VYM, and the other 25% is VUG, so indicating both value and growth. And in the second portfolio, everything is the same, but I changed out VYM for Divo. And here immediately in the second portfolio, the CAGR is a little bit more, and visually this is what that looks like. It's not a huge difference, and looking at the annual returns, pretty similar, But the big impact, of course, is the income level. And this right here is the true impact and benefit of adding Divo to your portfolio. It can really help to boost your income level. And that's without limiting total returns, as we can see up here, which is kind of the holy grail of income investing. So Divo is definitely a very special ETF, and I would say it's almost in a league of its own if it wasn't for jepi and xylg. These are the only ETFs on the market that can kind of compete with the annual CAGR of Divo, as well as the annual dividend income provided, because they have very similar strategies. And personally, I actually invest in all three of these ETFs because of their similarities as well as slight differences. But you have to remember, ETFs are not the only thing that exist on the market. Closed-end funds aren't as popular, but they can be very good for income investors, and CII is a great example of a high income and high performance closed-end fund that can really give Divo a run for its money. Over the past 5 years, CII actually has a slightly higher CAGR. These are the annual returns, and we can see that CII has more volatility. So in up years, CII goes up more, but in down years, it also goes down more. But the real shocker here is the income level, because closed-end funds have what's known as managed distribution policies. So to illustrate this really quickly, we're looking at the physical monthly dividend payments from Divo, and we can see how they fluctuate, but generally over long periods of time, they trend upwards. But CII in comparison is very different. Here, the monthly dividend payments are extremely rigid and predictable, and they also grow over time, and this is indicative of a managed distribution policy. Also, the taxes on these distributions are a little bit different, and I would say CII definitely has the advantage here. So the vast majority of the distributions from CII isn't actually from dividends, but rather long-term capital gains that the managers realize and distribute to the investors. And in 2021, that accounted for over 95% of the distributions from this closed-end fund. And in comparison to that, Divo has a mix of qualified dividends from actual blue-chip dividend-paying companies, as well as non-dividend distributions, and this comes from the call options being sold on individual stocks. And a quick heads up, a lot of the distribution for Divo is going to be classified as return of capital. But from my understanding, and keep in mind I am not a tax professional by any means, but the non-dividend distributions, aka the premiums by selling call options, is categorized as return of capital because it's not dividend income. So just something to keep in mind and potentially look into more if you're concerned about that topic. But also when it comes to return of capital, as long as the NAV of the actual asset is growing, it's usually not a problem, and here with Divo we have plenty of growth involved. So that's Divo revisited in 2022. And overall, I have to say, this is one of my favorite income ETFs on the market. The active management is actually doing a fantastic job in providing great overall total returns, price stability, and a high level of income. And considering the situation of the economy with rising interest rates, I think the strategy Divo has is poised to continue to do extremely well moving into 2022 and beyond. If you guys are interested in closed-end funds, definitely subscribe to the channel because I have a lot more content coming out on income-focused closed-end funds in the near future, as well as more comparisons with traditional dividend ETFs. So make sure you are subscribed for that. If you guys enjoyed this video, make sure to leave it a like before you go, and I'll see you guys in the next one.